Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I am Billy and I am joined by my co-host,
Andrew. Bill, it's good to be back for another podcast.
Andrew, it's always good to be back here with our listeners and our viewers. So absolutely. And got something that's really relevant and timely. So last week, Reserve Bank moved again, first Tuesday of the month of October. And here we go again.
Surprise, surprise. They didn't decrease rates, did they?
Well, look, it was a surprise.
It was actually it was not expected.
It was expected that they were going to move, but it was unexpected that they weren't going to move as small as they did or as little as they did.
Yeah, exactly. So, I guess that gives everyone the topic for today or what we're talking about today, which effectively is, the RBA increased rates. They went up by 0.25, so 25 bips. So we're now up to a cash rate of 2.6%. So what we're doing is talking about, what this means for the everyday person, what it means from, your household spending, your budget, and what you can do about it as well as some commentary around, what the RBA has come out with in terms of how they've formulated their decision. Which will hopefully give a little bit of insight as to, what's going to be happening in the future.
That's a good place to start, Andrew. So we might just talk about the actual rate rise and the fact that it was less than expected. Yeah. And I guess for myself and also for financial markets as well too, it's kind of exciting news. And I can't understand how you'd put a rate rise and exciting news in the same sentence, but I just did it, right? So RBA moved 25 points yesterday. We were expecting a 50 basis point rate rise, which is a positive, indicator from the Reserve Bank, and the commentary coming out, which we'll get to in a sec, but it's potentially signalling the change or the slowing down of these big 50 basis point rate increases. So that's the positive message that's coming out of it, that, hey, maybe we are getting to the end of that cycle. And the truth is we don't know, but maybe we are getting to the end of that cycle where these big 50 basis point rate rises are starting to taper off a little bit and just changing pace. Inflation's still an issue and the Reserve Bank are keeping an eye on it, but are we in a position where we're starting to turn that corner a little bit and just the foot is coming off the accelerator a little bit? Not sure, but that's what we're taking out of yesterday. That's why we're celebrating a 25 basis point increase rather than a 50 basis or crying over a 50 basis point increase.
Yeah, exactly. And look, the RBA commentary after the announcement kind of indicates exactly what you were saying as well, in that, there's very likely to be future rate rises. So that's something that's still on the cards. It's something that, they're still committed to bringing inflation under control. But what they have also stated within that is they are going to be cautious over it. And there's some commentary around the fact that it may be actually slowing down, and they may be softening the increases. In addition to that, they're keeping an eye on the economy and wanting to, everyone keeps using the analogy of landing on a narrow runway, and trying to keep the economy going strong while also keeping inflation under control without crashing the economy. So it's interesting to see, and it's hopefully giving some light at the end of the tunnel to mortgage holders, because it hasn't been a pleasant experience over the last 6 months.
Well, talking about that, we're going to go through some numbers later, just in terms of what this year has unfolded to be in terms of the impact of an average mortgage holder in Australia and what that has been, because the numbers, quite sombering. But we'll go through that in a sec anyway. But unemployment still remains relatively low, and that will continue to be like that just based on the data that we're seeing in terms of job ads as well. So that's also a consideration, one of the data sets that the RBA is taking into consideration when they are making their decisions around which way their interest rate moves, or how aggressive or what they do during their board meetings on the first Tuesday of each month. So one of the issues, obviously, unemployment data is something that they're keeping a really keen eye on, because if we have higher interest rates and higher unemployment, then we get into a really challenging position that people can't afford to live. Once again, if you've got competing pressures with inflation, what do? Do you protect the economy by trying to raise interest rates and get inflation under control? Or do you then take a breather and say, actually, people are struggling here, we need to go the other way? And in Australia and over the world, all of the people who are making decisions about monetary policy are saying that we need to get inflation under control.
Yeah, exactly right. I mean, we saw, the US put their rates up by 0.75% in their last meeting, which is, it's an interesting concept, right? Because it's a large rate rise, but they don't meet as often as what the RBA does here in Australia. But another interesting concept is in the US, most of their loans are in fact fixed loans over the term of the entire loan period. So really what they're doing is impacting new borrowers, not existing borrowers. So we've seen some comparisons around, the US is doing it, so Australia can do it as well. It is a different economy. The way that their, household mortgages are structured are different. So looking at it, purely from an Australian lens rather than just an international is also an interesting thing to take into account as well.
On a positive front, the share market reacted last week to the news.
Yeah.
Extremely positively.
Yep.
I think we saw just headline numbers, about $81 billion added back to the All Ordinaries Index last week.
So it's clearly some welcome news to the share market.
So look, maybe we're trying to, it's like when you're trying to stay positive about some sort of positive news, you're trying to pick the thing out. But no, honestly, in terms of the All Ords, it responded, I'm struggling to scratch my head around when we've seen, okay, it's only been, a short period of time, but when we've seen the market rally like that out of the back of some news.
Yeah. And really, I guess the interesting concept to draw out of it is how preemptive the share market, because when you look at that bit of information in isolation, an interest rate rise is usually not good news for share markets, but it shows how preemptive the share market is, because even though it's what is, when you're looking at it black and white, not positive news for the share market, it's more positive than expected, which causes a rise. So it really goes to show that, the share market is preemptive and doesn't base information on just the information that's available, but what market expectations are going to be like. And so even though it's bad news for share markets, it's not as bad as expected. So you see a rise.
Yeah. So, and maybe that's it. Maybe it's just, hey, this is the start of it changing or turning, or maybe it's just a positive indicator that, hey, the RBA, the governor in particular, is not just hell-bent on just going, bang, this is what we're going to do. He's actually doing his job and collecting the data and making informed decisions based on the data that they're getting. I don't know. It's going to be
really interesting if we shoot ourselves in the foot and we're doing a podcast in a couple of months' time, and it's the RBA has increased rates again. They've gone 75 bips this time.
Well, look, we're not making the decision, so it's. I would not like to be in his shoes. I must say, but no, you're absolutely right. It's and that's the thing. I think it's using the data that's available to be able to make a decision. And realistically, when you're making a decision in lieu of that, what are you doing? You're using gut feel, intuition, broken data sets, incomplete information. The person or the board that are making decisions about impacting so many Australians and our economy, that's what you'd expect. So yeah, share market reacted positively to that. And hopefully that's a sign of things to come. So only time will tell.
Yeah, exactly right. So jumping into it now, Bills, and this is, both a depressing story, but also hopefully can give some insight and some ideas on, what you can do to combat it. But let's start running through what's the impact to the average homeowner, and how have they been impacted from a cash flow on a home loan side of things by these rate rises?
I feel like our conversations are going positive and negative and positive and negative, right?
So people's emotions.
It's like the Disney movies where they euphoria and then there's the drama and we're trying to get the formula right. No, probably a good place to start with this is, where were we before interest rates started to move? So what we're going to use a $600,000 loan as an example. Using the ABS statistics, that's the average loan or average mortgage in Australia. And we'll use a 2% principal and interest loan over 30-year term, right? So what that was before everything, you'd be looking at a monthly repayment of about 2220, so 2220 per month. And the interest that you'd pay over the life of that loan is about $200,000. So you'd borrow 600, you'd end up paying 800 back. 600 would be principal, 200 would be interest, but your monthly repayments, would be $2,220 per month. Now, between the bottom of the rate cycle when the cash rate was 0.1 and now we're sitting at 2.6, we're talking about a 250 or a 2.5% increase. The difference on that same loan, so once again, $600,000 loan, 4.5% interest rate, 30-year term, principal and interest, the repayments are now $3,040. So you're talking, what are we talking, $780, if I've got that quick maths right-ish, difference per month. Really significant, but the next number will absolutely blow you away. Yeah. In the previous example, the interest paid over the life of that loan was $200,000. In this instance, it's $495,000. So we're paying an extra $295,000 in interest over the life of the loan. Now, once again, that's a flat line calculation, taking absolutely everything else out of consideration, extra repayments, changes in interest rate, offset accounts, the works, but just a real simple comparison. You're talking about a cash flow issue of $780 per month, and over the life of the loan, almost $300,000 in additional interest paid.
I think that second one is, at least for me, that was the thing that really hit home probably the hardest, because look, $780 a month, that's when you're talking about cash flow, when you're talking about household budgets, that hurts. And you couple that with the inflation that we're experiencing, and the fact that people are spending more money for their groceries, their fuel, all of the other expenses as well. And then on top of that, your home loan, you're also paying $780 in additional repayments. That's a decent sum of money. But when you start talking about, over the life of the loan, $200,000 worth of interest versus almost $500,000 worth of interest, that's a massive difference around, the just pure interest alone that you're paying in order to be able to repay your mortgage. And that's based on a $600,000 loan. If you're talking about a larger loan balance, then, the impact of it is exacerbated even further.
I mean, it just hasn't been a consideration for such a long period of time because rates have been so low. But in saying this, I mean, $300,000, and let's put it into context. Like, as a household, what I'm thinking of is that monthly figure. What happens in 30 years, or I shouldn't say 30 years time, but how much interest I pay over the life of the loan? Yeah, it's absolutely critical. And we'll talk about that from a wealth creation perspective and things like that in a minute. But what I'm looking at is the cash flow ramifications. Month in, month out, can I afford that? And if you can afford that, I guess it then buys you some time to be able to navigate to try and get that $500,000 of interest payable down.
Yeah.
But if you talk about that from a wealth creation perspective, I mean, paying that much money, $500,000 in interest, but $300,000 more than what we would have been paying on a loan at the start of this year. If you took that money and invested it over a 30-year term, I don't know what we'd get. I don't have the calculator in front of me, but you're talking about a significant amount of money that is going to servicing a mortgage, a household. You're not getting, all else being equal, you're not getting anything additional for it. Yeah. Your capital growth might be different, don't get me wrong, but if you had that money and invested it, that extra $300,000, you could turn that into, well, depending on how you play it, but you're talking a substantial amount of money.
Yeah, absolutely. Absolutely. And I think the interesting thing and the thing that's been very difficult to swallow for homeowners is that short period of time. I mean, we're talking, really 6 months.
Yep.
That there's been, in a period of 6 months, your budgets are now out by $800,000 almost. Sorry, $800,000, $800 per month. Yep. When the expectation was that interest rates were always going to rise. I don't think anyone expected that interest rates would stay at 0.1%, over the life of a loan, and now sort of bit him in the backside. But the governor explicitly came out and stated that interest rates would likely not rise until 2024. Obviously, there's been some external factors that have impacted that, and he's copping a little bit of backlash for that. But the period in time that households have had to adjust to this has been really nothing. Like it's a blink in, or you blink and all of a sudden you're, paying an extra $800 a month in terms of repayments. So had this happened over the course of, 2 or 3 years, households would have time to adjust their spending, adjust their budgets and their cash flow in order to be able to account for it. But when it happens in a 6-month period, it does make things significantly more difficult.
Yeah, and I guess that's the challenge with interest rates as well. Like, it's not just make the decision, move the rate, the banks then interpret what they're going to do, push that down the line. 2 weeks later, your mortgage is 25 or 50 basis points higher. By the time you then feel that, so there is a lag effect. Yep. So by the time you then feel that, it takes time for that to wash through. And it just got me thinking around, okay, we're in October now, starting to approach December and Christmas and that big retail spend for the Christmas shopping. It'll be interesting to see when the retail season is finished and the data comes through, what impact that's going to have sort of year on year, because this is the first time in a long time where we're going to go through that with much, much more expensive costs associated with servicing our mortgage in particular.
Yeah, exactly. So yeah, it's going to be very interesting to see what, household expenditure is like over, the Christmas period and what's traditionally been the retail period for for retailers out there. Like that's going to be some very interesting data and statistics to comb through.
Talk about a roller coaster ride. Like if you think about being in retail, traditional retail, yep, and going through COVID, supply chain issues, and now this. Anyway, that's a complete. Yeah. Maybe that's for another podcast, Andrew. Who knows? But look, what we should do, I think will be really relevant to our viewers and our listeners, is to try and leave everybody with something, a few things that we can talk about, and what we're actively having conversations with our clients in terms of, hey, what can we do? We know that this is the case. Other than selling your property, you don't really have much of a choice. If you need to stay in your property, you're going to end up, obviously absorbing some higher cost. So Andrew, how do we go some way of trying to offset this to try and limit the impact that this is having to our households?
Yeah. Well, look, the first thing that you should be doing is, and I think that this is the cornerstone of any financial plan, is having a cash flow management and a budgeting plan. Being able to have that structure means that you can identify expenses and you can identify what's, increased more than it probably should have, and you need to look for a cheaper alternative. So we're talking, your car insurance, we're talking your home and contents insurance, your non-discretionary expenses. You want to identify what you can, really receive either an equivalent or a viable alternative for a cheaper price, but it makes it a very difficult proposition to do so when you don't have a cash flow budget or a cash flow and budgeting plan in place. So making sure that that's in place, which we'll talk through in a second afterwards, is probably the first thing that you really need to make sure that you have, so that you can identify, with this interest rate increase, am I now in, negative surplus income?
Yeah.
Do I need to do something more drastic in order to, make sure that I'm not eating into my savings and eating into my capital? Or am I still okay? I'm just going to be saving less money than expected. And what I'm trying to do is really, get back up to the savings and investment figure that I was before. But non-discretionary expenses is one of the key easy wins. If you can, identify an expense that you're going to have to pay for anyway, but either, reduce it down or even eliminate it in its entirety, that's going to go a long way into improving the cash flow into the household.
Yeah, I really like that. I mean, that's the same for anything in life, I guess. You can't improve it unless you can identify it.
Yeah.
So we'll talk about the cash flow management system and maybe a bit of a shameless plug for what we're doing with our clients, because it really works. But on that note with yours, in terms of your purchasing habits, and this is more of the discretionary spending and the point of sale spending, sort of using the words from our cash flow management system, changing your habits associated with that. So really for me, it's a handful of things. You kind of go through the need versus want. That's pretty straightforward. So do you really need it? Do you want it? There's a huge difference between the two. Can you defer that purchasing decision and sort of kick the can down the road? Or can you eliminate that? So if it is a want rather than a need, that obviously makes sense. But if you're going to purchase something, is there a cheaper alternative that you can possibly do? And we've seen it in the media recently around people buying, different types of meat. They're going for more of the ground up meat rather than the higher quality stuff and things like that. I don't really like to use food as an example with that, because that's probably the last thing, that
maybe our cultural background. We're both Greek. We want to eat, good quality food and all of that. So it doesn't, not something that we want to cut back on.
Andrew's right. There is some personal bias in that, but I'd prefer to cut back on the other stuff first before I actually change what I'm eating.
Yeah.
But as an example, if you can change to a cheaper alternative with the stuff that you are purchasing, and look, maybe it is only a temporary blip in time. We're looking at this, who knows how it's going to last, but over the length of the entire time frame, maybe it is something that's just short-term in nature, relatively speaking. So if we are pivoting and making those decisions, hopefully it's something that we only need to do for a short period of time.
Yeah, or you make those decisions, and as things improve, you've got additional surplus income to invest and save, and
then you get used to it. Yeah, you get used to it, and all of a sudden,
it's easy to do.
Yep.
The other thing which I think is key in all of this, because it can have a really substantial impact, is looking at refinancing your home loan. So if you haven't already, or if you haven't reviewed your bank or your mortgage provider, to ensure that they're still the most cost-effective option, review it. I cannot speak more highly about what mortgage brokers do and the impact that can have. You take a 0.5% reduction in interest rates, and all of a sudden there's additional surplus in your cash flow, and in addition to that, there's also less interest that you're paying over the life of the loan, and really there's no difference in what you're receiving at the end of it, because you're still paying a mortgage, and a mortgage isn't something that you're wanting a quality product over another. It's something that's the same either way, or whichever way you go. So making sure that your lender is the most competitive interest rate, or the most cost-effective option for you is really important, especially when there's such movements in the market.
Yeah, that one there is really it's an obvious one, and we keep coming back to that, because if you look at a household budget and the composite of that, mortgage repayments, broad brush rule of thumb, you're sitting high 20%-ishes. In terms of how much it's taking of your budget. So that's the biggest, I guess, line item.
Yep.
So that's the one that we tend to gravitate towards. And it's the process of going through a mortgage broking refinance is simple if you're working with the right broker. The most inconvenient part for you as an individual is just needing to change your online banking. Here we go. I'm trying to tap with my phone, right? But last week it was the tap, and this week I'm...
Yeah, exactly.
But yeah, basically changing the apps of who you bank with and potentially tweaking around some of your direct debits and stuff like that.
Yeah.
But yeah, that's obviously a big one from that perspective. From my point of view, get advice. So we are having bigger and bigger conversations around cash flow, around household budgets. You rewind not that long ago. Yes, absolutely, we were having those conversations anyway, but now it's forming kind of the bedrock and the basis of where we're starting and then moving out from there. So get advice, because getting advice can give you the peace of mind, can give you the structure, can give you the strategy, and also help people. And I think that this is a really big thing, is from an emotional perspective, help turning down the noise and just getting realistic about this. I mean, every time we go through hardship, we all think this is the worst that it's ever been. And I'm not necessarily saying this is not, because this is having a real impact that people are hurting. But, if you look back on this period in the future, hopefully, and we'll only know this with the benefit of hindsight, but hopefully we get through it as quickly and as unscathed as we possibly can, and we all survive it.
Yeah.
So from my perspective, it's definitely get advice.
Yeah, absolutely. And again, a bit of a shameless plug. So we've actually launched a cash flow bootcamp. So what we're doing is running our clients through really 4 separate sessions. It's individual. So it's all face-to-face with an individual advisor, and we take them through the process of setting up their budget, setting up their cash flow, and making sure that everything is in the most efficient and effective way to meet their financial goals. We've seen some really kind of mind-blowing results with it in terms of the impact that it can have in a relatively short period of time. And it's something that, I think anyone really can benefit out of, whether it's, can I get more out of my cash flow? Can I do more with the money that I'm earning? Or whether it's, hey, I'm in, dire straits and I need some help to sort this out. There's definitely a whole heap of value in that as well.
Heading into spring, doing some spring cleaning at home, cleaning the garden, throwing some old clothes out, all that sort of stuff. Geez, it feels good, right? Do this with your cash flow. It's the same impact. It's just getting organised, right?
Yeah.
So you've got different parts of the spectrum, but it's a feel-good exercise as well too. So
maybe we can, create a bit of a, buzz around it, and maybe even make it a cash flow, your spring cash flow cleaning, or I don't know.
Maybe, who knows?
Make a holiday out of it.
That's it. So Andrew, hopefully we've ended that on a positive note for everybody, that there are some things that you can do, and it's not as bad as what we were, I guess, expecting out of the rate rise last week. So yeah, hopefully we've left our listeners and our viewers with something to be a bit more optimistic about.
Yeah, absolutely. Bills, thank you again for another great podcast, and thanks again to our listeners and viewers for tuning in, and look forward to catching you on the next one.
See ya.
Thanks for listening today. If you have any questions on what we talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature, and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.